For decades, the financial goal is simple: save, invest, and build the pile. But the moment you retire, that entire dynamic flips. You transition from accumulating wealth to drawing it down. In retirement, the primary threat to your lifestyle is longevity. When you no longer have a salary to lean on, the risk of outliving your savings becomes a math problem that most traditional portfolios aren't designed to solve. Financial planners call this sequence of returns risk. A portfolio climbs for years, until a sharp, sudden drop directly on retirement day. Selling shares at this bottom to pay for groceries permanently locks in losses, destroying its ability to ever bounce back. Traditional safe havens like bank certificates of deposit or government bonds often fall short here. They generate an annual tax bill that drags down your returns, and because they are finite pools of money, they can eventually be completely depleted. Individual assets are limited by your account balance, but insurance companies operate on a different scale. By pooling risk across thousands of policyholders, they provide a contractual guarantee for a monthly paycheck that continues for as long as you live, a commitment no other financial institution can make. Eliminating the fear of going broke requires a different approach to your portfolio. You have to shift your focus from simply holding assets to legally guaranteeing your income distribution. Converting those savings into lifetime income requires matching the right tool to your specific schedule. The strategy depends entirely on when you actually need the cash flow to start. Let's look at the first timeline. Suppose you need an income stream to start right now to cover your essential daily living expenses. For this exact situation, the standard vehicle is a single premium immediate annuity, or SPIA. This animation illustrates the mechanics. You transfer a single lump sum, and within 30 days, the insurance company breaks that down into a permanent, guaranteed monthly payout that begins immediately. If you are entering retirement without a traditional corporate pension, the immediate annuity serves as a straightforward replacement to lock in your baseline survival numbers. But what if your current expenses are completely covered, and your real concern is running out of money in your 80s or 90s? To neutralize that specific threat, you would use a deferred income annuity, or DIA. With a deferred annuity, you secure the contract today, but you deliberately tell the insurance company to hold off on the payments for 5, 10, or even 20 years. This chart shows why that delay works in your favor. Because the insurance company has decades to grow your initial premium on the left, the resulting monthly payouts on the right are significantly larger. This structure acts as a targeted longevity shield. It ensures you have maximum financial firepower waiting for you in the final chapters of retirement, precisely when your other accounts might be running dry. Of course, many retirees want the comfort of guaranteed income, but they do not want to lock their capital away into an irrevocable stream. They want access. That brings us to the flexible middle ground, the fixed indexed annuity, or FIA, paired with an income rider. This split-screen graph shows how an indexed annuity behaves. The top line shows the stock market taking a deep dive. But look at the bottom line. The annuity value plateaus. It captures market growth, but stays flat during a crash. While your balance is protected, the attached income rider constantly works in the background, steadily building a separate, guaranteed base for future withdrawals. Because you haven't permanently traded away your principal, you retain the ability to access that cash value for unexpected emergencies, or leave whatever remains as a legacy to your family. An indexed annuity provides a way to participate in market growth without exposing your retirement principal to the risk of a market correction. When you look at the complete retirement picture, these three structures do not compete with each other. They are highly complementary building blocks that can be used together. This visualization shows an approach called laddering. By mixing immediate, delayed, and flexible annuities, you can capture different interest rates and maintain rolling liquidity at varying intervals over a 30-year timeline. Beyond the income guarantees, these contracts provide two significant secondary benefits. They grow completely tax-deferred without the friction of annual tax bills, and they bypass the costly public probate process to transfer directly to your named beneficiaries. There is a structural problem in how most people buy these, however. If you rely on a single carrier insurance agent, you only gain access to whatever narrow fraction of these timeline solutions their specific company happens to sell. This is why working with diversified insurance brokers is essential. They are an independent, family-owned agency that has been operating since 1980. They hold active contracts with over 100 top-rated carriers, allowing them to scan the entire marketplace on your behalf. To analyze your exact timeline and find the correct products to eliminate your income gaps, book a consultation with Diversified insurance brokers today. You can mathematically lock in a stress-free retirement, no matter what the market does next.